want to start off with what's most important for most retirees, which is kind of the foundational approach to their retirement, which is tax efficient withdrawal strategies. Because how you pull that income in retirement is just as important as how you invest it. And so deciding on the withdrawals that you do in your taxable buckets that we'll touch on can actually leave you with a greater potential in your nest egg, but also minimize the taxes overall in your financial plan. And so I'll briefly touch over the One Big Beautiful Bill Act. So this act that recently passed, so for most retirees, this act made tax efficient withdrawals actually better because it created extra deductions. So for example, the $6,000 increased standard deduction for those that are 65 and older. It increased the SALT cap. And so if you were to itemize deductions, now you have up to 40,000 instead of the SALT cap for 10,000. And so all these changes as of this recent passing lets retirees withdraw more each year, often with little to no federal tax if you plan your withdrawals right. And so these larger deductions pose a great tax planning strategy for most retirees. And so starting with the foundation, so picture your retirement savings divided into 3 buckets. So we have tax-free, tax-deferred, and taxable. Each of these buckets are taxed differently, so the order in which you pull from them can actually determine how much stays in your pocket. And so we'll talk a little bit about each of these, how they're taxed, and how they affect your retirement income. And so for tax-deferred as the first account, you're probably familiar with this during your working years, so traditional IRA or 401k. And so with these accounts, you're making pre-tax contributions. So you're taking an immediate tax deduction in the year you make a contribution. And then those contributions are going to grow tax deferred, meaning there is no annual taxation on them. They're going to compound over the years. But when you eventually withdraw from these accounts, they're going to be taxed at ordinary income rates. And as we can see on the far hand right side, this is the brackets for ordinary income for 2025, and they range from 10% to 37%. And so the more you withdraw from these accounts, the more likely you are to reach the higher end of these brackets. So think of it as like your paycheck that you're earning from your job. You're paying ordinary income tax when you pull from this vehicle. A downside to the tax deferred accounts is usually what's considered RMDs, so required minimum distributions. And these are forced distributions to you, whether you're age 73 or 75, it depends on when you were born. So if you were born in 1960 and later, your RMD age is 75. And so RMDs pose a tax problem if you're not looking to optimize your retirement, because it might actually push you into higher tax brackets without you even knowing. And so next is taxable accounts. So these are going to be like your brokerage accounts, individuals, joint rights and survivorship. And these accounts, you're making contributions that are after tax. So the money you're putting into these accounts has already been taxed. And there is no immediate tax benefit. You're just investing for the long term, usually, or short term, depending on your goals. But it is also considered a leaky bucket because it has annual taxation, because any interest, dividends, and capital gains accumulated in this account is taxed in the year that it's realized. And so let's say if you buy an investment and hold it for a year and some change, you're actually going to pay capital gain tax rates. So they're more preferential compared to ordinary income tax rates, because remember, ordinary, you're paying 10 to 37%. But here in the capital gain tax rates, you're paying 0 to 20%. And the brackets here are actually bigger than in the ordinary tax brackets. And so you just want to make sure in the terms of the investments that you put in there, that it's not as tax dragging your whole retirement plan. And so it's flexible, so there is no contribution limits, there is no penalties or income restrictions, and it also receives a step up in cost basis, meaning let's say your parents bought 20,000 worth of ConocoPhillips stock, for example, and then it's worth 50,000. When they pass and that stock inherently goes to you, your basis is now 50,000. It's not that 20,000, it gets a step up to its fair market value. And so you can immediately turn around and sell it, and there is no tax consequence. And so that's the benefit of a taxable account. You get the step up in cost basis. And so it's good to think of it as a legacy vehicle for heirs. But again, since this bucket is a little bit leaky, we want to make sure that the investments here are proper. So we don't want income heavy producing assets. So if we're putting fixed income in here, we want to put municipal bonds because they're tax free federally. And then any highly appreciated assets held for the long term are most beneficial here because you take advantage of the long-term capital gain rates. But again, if you have interest income and you have an asset and you buy it and sell it in the year, well, then you revert back to the ordinary income tax brackets. So we got to make sure the assets are held long term. And then for the Roth account, so this is a tax-free bucket, is consistent with your Roth IRA and your Roth 401k. And so with your contributions into these accounts, they're after-tax contributions. So you take no deduction up front. But the benefit of these accounts is that any growth and any future withdrawals are tax-free. And so that's great compared to the tax-deferred accounts where you are deferring taxes, but you will eventually have to pay them. Here in the Roth accounts, it's all tax-free, assuming you reach age 59 and a half and you have funded it for 5 years. And then also the benefit is there is no required minimum distribution. So you're not forced to pull money out of this account compared to the tax deferred accounts. So like traditional IRA and traditional 401k. And so this can provide greater flexibility when it comes to tax management in terms of tax brackets and your income strategies, as well as a vehicle to leave for heirs, because if you leave this to your heirs, they pay virtually no taxes. And so that's a good benefit of this vehicle. And so throughout your retirement, you might have been told the conventional withdrawal strategy. So when you go to retirement, hey, you should pull from your taxable accounts, then you should pull from your tax deferred accounts. And then once that's depleted, you want to pull from your tax-free accounts. So taxable accounts, again, are just like brokerage accounts. Tax deferred is like your traditional IRA, and tax-free is like your Roth IRA. But there's an inherent limitation to this strategy in that if you're pulling straight from your taxable accounts, well, yes, you're getting tax deferred growth in your IRAs, but then that could lead to the RMD issue. So basically a tax bomb in the future. And so instead of probably paying 10 to 12% now in the early years of retirement, pulling from that tax deferred account, now you're going to be bumped up into potentially the 22 or the 24% ordinary income tax bracket because you delayed drawing from that tax deferred account. And also it ignores opportunities for tax optimization. So remember with the passing of the bills, we have increased deductions. So we can actually withdraw from those tax deferred accounts at virtually zero taxes because of those deductions. And so with the taxable accounts, you're just using tax preferential accounts for basically filling up the bottom of the bracket, but it's not as efficient. You want to be able to pull those tax deferred accounts. And then also, it doesn't account for any changing tax legislation. So again, increased deductions, we want to be able to utilize those the best we can possible because again, we're not trying to minimize taxes for just this current year. We're actually trying to maximize your taxes over time, try to spread it out to pay less taxes than you otherwise would have. Now, we can go through an example of a kind of a tax efficient withdrawal strategy. And so here we have Jerry and Michelle. And so both of them are age 60 and they have an income need of 100,000. And so they have a portfolio size of 1.5 million, and that's broken out to traditional IRA, your taxable account, and Roth IRA. So they need $100,000. All right. So we're going to say we're going to pull 31,500 from their traditional IRA. Well, why specifically that number? Well, in 2025, the standard deduction for married filing jointly would be 31,500, taking advantage of that standard deduction, which means this withdrawal is practically tax-free. There is no taxable income, but we still need to make up the 100,000. Well, then now we're going to go to the taxable account and we're going to pull 68,500. Now I have right there 60% basis. So In other words, for every dollar we pull out of the taxable account, 40% of it, sorry, 40% of it is going to be taxed at, there you go, long-term capital gain rates. And so for here, that taxable income is going to be 27,400. And so remember, on the left-hand side, we took the standard deduction, so there is no taxable income there. And if we look in the middle, the only taxable income we have is 27,400. But this amount is less than 96,700. And so why that is important, because in the capital gains tax rate, you can have taxable income up to 96,700 and pay zero capital gain tax, which means this withdrawal is also tax-free. And so with this withdrawal strategy, they're able to pull about 100,000 in tax-free income. And so utilizing the standard deduction, so withdrawing from their traditional accounts, helping at least the back end to reduce that potential RMD in the future, and then keeping within a certain tax bracket target. So if we're trying to stay in the 10 to 12, we'll use traditional assets for that. But if we don't want to increase our tax or marginal tax rate, we would use taxable accounts or a combination of Roth. And so that's what leads me to kind of the final example here in this section. This is going to cover the both strategies in terms of their overall tax impact. And so here we have the key assumptions on the right-hand side, but I want to draw your attention here. And so for this example, the conventional wisdom is just that conventional approach. It's taxable accounts first, tax deferred, and then tax free. Where here, over the lifetime of their retirement, over the 30 years, they paid an estimated tax of 99,524. But if we talk about tax efficient withdrawal strategies over here on the far right, their personalized strategy, they actually paid a cumulative tax of 66,000. So they actually end up saving 34,000 in potential taxes because they changed the way they withdrew from their accounts. And so traditional conventional withdrawal strategies don't always work for every individual. And so that's why a personal approach is often best when it comes to your own withdrawal strategy. And so by understanding kind of how to sequence your distributions across your taxable accounts, your tax deferred accounts, and your Roth accounts, you can better control the tax throughout your retirement. Remember, we're trying to maximize your overall taxes for your retirement, not just the current year. And so I'll leave it there.
All right. We do have a good question, Oscar. The question is, what kind of investments are better for taxable versus tax deferred accounts?
Okay. So in the taxables, as I mentioned, it is a leaky bucket. So we don't want to have any high income producing assets in there because, again, it's taxed annually. And you actually want to have long-term growth assets potentially in there because you want to participate in the capital gain, the long-term capital gains rates. Because if you have income producing assets, you're going to pay ordinary income tax on that. And so you actually want to reserve those into the tax deferred accounts because, again, any growth and interest in that account is tax deferred until you in the future go ahead and pull it. But in that taxable account, you want to close as many leaks as possible just so that there isn't any tax drag. And so I would say just keep highly appreciating assets in the taxable accounts, low dividend yield, no income producing funds, and then most of those income producing funds in the tax deferred accounts. And that's how I would kind of structure it just to prevent any inefficiencies in both buckets.